Tesla stock at the time of recording this video is up around 0.5%. It really got beaten down in the beginning of trading. It bounced off of a very important technical level. We'll talk about that here in this video. But let me share with you, before we get into all of the good news today, and there is a lot of good news, look at this bad news. And let me put this into context for you. This article says Tesla sales and market share in Europe drop again in February. Is this headline true? Yes. But putting it into context, is it fair? Not really. It says Tesla's market share falls to 1.8%, down from 2.8% last year. Tesla sold fewer than 17,000 cars in Europe in February versus the over 28,000 in February of 2024. So Tesla's deliveries are down roughly 11,000 from February of 2024. It says that Elon Musk's political controversies may have impacted Tesla's European sales. Overall, BEV sales in Europe rise despite Tesla's decline. There is zero mention here of the new Model Y that was not even selling in Europe in February, that is just now starting to be delivered to customers. I think it's kind of unfair to paint Tesla with this brush when the top vehicle in the world is not selling in that region, okay? With that kind of out there, with that perspective out there, I actually think February's numbers were really strong. Now it says Tesla commanded 1.8% of the total market and 10.3% of the BEV market in February, down from 2.8% and 21.6% respectively last year. And I think these numbers with the Model Y, if that was in full production, it's business as usual in February, you would have seen roughly the same numbers, if not better numbers for Tesla. The real test is going to be March and April, but to a more extent, really April, that's when we should be getting into higher production numbers of the new Model Y again. Now, this Reuters article actually had a link to this article, which was posted on March 14th, and I think a lot of people may have missed. It says that Tesla plans Model Y costing at least 20% less to produce to defend China share, essentially to recover some of the margin that was lost during the price war that mainly happened in 2022 and 2023. I don't know about you guys, but I don't exactly remember this news being breaking news. For the best-selling vehicle in the world to make it 20% cheaper is actually going to be huge for margins. But neither here or there. That is why Tesla went under pressure in the beginning of trading today. But it is good news that you bounced precisely at this trend line. Like, I don't know how much more perfect it could have been, like down to the penny you bounced at that trend line on the downside. This trend line connects the lows of April of 2024, the low of August 5th, the low of October 23rd, and the gap down level that you had on March 7th. Okay, so this is a pretty good sign of support short term for Tesla, which could mean the stock is still likely to move higher from here. But unfortunately, the good news kind of gets shoved under the rug, and Wall Street still seems to only focus on the bad news. Now, here's a little bit more quote unquote bad news. I think this is a little bit of bad news, but we'll get figured out. It says Tesla has halted its FSD free trial in China due to recently implemented guidelines by Chinese authorities requiring pre-authorization for over-the-air software updates. These measures came into effect in late February 2025. Tesla will roll it out again when they get regulatory approval. So more technical in nature. It It's not really a big deal. Tesla has secured a new $132 million megapack contract in Australia with a power capacity of 250 megawatts and an energy storage capacity of 500 megawatt hours. This battery energy storage facility will have enough power to supply electricity for up to 115,000 homes during peak periods. Tesla's AutoBidder software will also be used. EVG has announced a partnership with Tesla to build 3 V4 supercharger stations in the US. And I always say the more the merrier. I don't care if it's Tesla, I don't care who has the charging stations, I don't care who has the best tech, okay, the fastest charging capabilities. We need more chargers. The moment EVs will become mass market and the more dominant than gas vehicles is when you can charge your EV at about 5 minutes. The average time or so it takes to fill your gas tank. Once we're to that point, then nobody's going to buy a gas vehicle anymore. And according to a new report, Tesla has, quote, staged a comeback in Norway's EV market with the launch of the new Model Y. With deliveries starting domestically, the new all-electric crossover has reclaimed its spot as Norway's most registered car this month and year to date. So all of those demand concerns, brand concerns, Elon's political affiliation concerns, none of that is going to really impact Tesla in the more medium term. Piper Sandler analyst Alex Potter has reiterated an overweight rating and $450 price target on Tesla, adding that Tesla's brand damage may be exaggerated. He says, quote, "It's correct when investors and or journalists point to politics as the primary driver of Tesla's double-digit year-over-year delivery declines in Q1. Yeah, I think that's accurate. That's incorrect, okay? Alex cited supply issues rather than demand weakness were a key factor. In addition, Alex believes multi-week shutdowns impacted all 4 of Tesla's Model Y factories, limiting the company's ability to fulfill orders even if demand had been significantly stronger. Piper Sandler also sees potential catalysts ahead for Tesla, including new product unveilings in the coming months and highly anticipated robotaxi launch in June. The firm feels these developments could help offset concerns over recent delivery trends. Again, when the Model Y is cranking out globally to the same extent it was in December or in November of last year, back to full production, nobody's going to be talking about demand issues for Tesla. And the FBI has announced today that they are launching a new task force to investigate attacks targeting Tesla. They say, quote, "This is domestic terrorism. Those responsible will be pursued, caught, and brought to justice." And Canaccord Genuity analyst Giankas visited Tesla's Giga Texas factory a few days ago. He says, quote, "We toured the Cybertruck line and saw firsthand elements of the future unboxed manufacturing strategy that promises to materially increase production efficiencies. It's hard not to be impressed with how future forward Tesla is, whether it's vehicle design or manufacturing, consistently rethinking the status quo." And then there was FSD V13.2.8. Yes, it was in Austin on a sunny day on a known path, but it was smooth. 0 interventions, great highway merging, no issues. And the new Model Y, we really liked it in person. Not to mention the gold Cybercab we saw roaming the Austin campus, future forward. He reiterates his $404 Tesla price target. And it's also being reported today that the new legacy Tesla Model Y inventory is now completely sold out in Florida. It says Tesla continued production of the legacy Model Y, pictured below, well into Q1 to have enough inventory while they switch production over to the new refreshed Model Y. And boom, look at this. Tesla registered 17,400 new Teslas that were insured in China last week. The best week so far of 2025. Do you hear anyone talking about this today? Not really. In this same week last year, you insured 13,200 Teslas. Now you're 17,400 in this week of 2025. What's actually fascinating is year to date, you are now higher for insurance registration numbers in China than you were year to date up until this point in 2024. This week of 2024, you had 115,900 total registrations. As of today, you're at 116,200 total insurance registrations. Is anyone talking about this? Not that I've seen today. And honestly, with the new Model Y now really starting to be delivered in China, I wouldn't be surprised if we're hitting some pretty crazy numbers here soon. We're talking 20, 25, even potentially above 30,000 registrations for some of these upcoming weeks. And then I think it's going to kind of catch some of the headlines that Tesla year over year in China is massively accelerating. And why I think that's key is because we get this data out of China, but we don't get this data for the US. Now, Europe is a much smaller market than the US and China. So what really moves the needle for Tesla is China and the US. It's not Europe. So you can have 40% declines year over year if you're looking at specific months in Europe. But that's not going to really move the needle too much for total deliveries for Tesla in a quarter if the US and China do really good. Like, you could have Europe down 40%, call it 100,000 vehicles get delivered roughly every quarter in Europe. You could have 60,000 vehicles delivered in Europe for, say, Q1, Q2, doesn't matter what quarter you're thinking of. But if Tesla in the US and China go up just 15, 20% year over year, you're going to smash the delivery estimates. So Europe is a much less important market than China and the US. We don't know what the US looks like, though. But I would imagine if China looks good, the US probably looks good as well. Maybe even better. And Tesla announced today that they are officially launching in Saudi Arabia on April 10th. And Cathie Wood remains bullish on Tesla and sees the company hitting $2,600 per share in 5 years, she said in a new interview out today. But beyond that, the big talk today is tariffs and recession. Believe it or not, there's more people pulling out those recession cards. So first things first, CNBC does a quarterly survey of CFOs, of corporate CFOs, chief financial officers. The bottom line is recession is coming before the end of 2025. They are generally pessimistic, says corporate CFOs. It goes on to say that 95% of CFOs said policy is impacting their ability to make business decisions, and many said while Trump is delivering on promises, his administration's approach is too chaotic, disruptive, and extreme for businesses to navigate effectively. Wow, that doesn't sound good. In a word, the, quote, pessimism has creeped back in where the animal spirits had been after Trump's election. That's one way to sum up the results from the latest CNBC CFO Council quarterly survey for Q1 2025. While some chief financial officers said Trump is doing what he promised on the campaign trail, many CFOs said the way he is going about delivering on his agenda is not what was expected. Quote, too chaotic for businesses to navigate effectively was how one CFO respondent framed their view of Trump's second term to date. Extreme, disruptive, aggressive, a wild ride were some of the other ways CFOs portrayed their current view. In all, adds up to a majority of CFOs, 60% saying they expect a recession in the second half of the year. Another 15% say a recession will hit in 2026. So effectively, 75% of large company CFOs expect a recession over the next 12 months. Just a quarter ago, when the recession question in the quarterly survey was laid out, the Fed, rather than Trump, in the Q4 2024 survey, we asked whether the central bank's efforts to tame inflation would lead to an economic slump. Only 7% of CFOs said they thought that was on the calendar for 2025. Wow. In recent weeks, recession has become a more popular default setting in the market for the first time since the Fed began aggressively raising interest rates to beat back runaway inflation in March 2022. The odds of recession are running as high as 50% at some financial firms. New, quote, recession watch indicators are being created, and other recent CNBC surveying among money managers and economists shows a spike in recession fear. U.S. trade policy is the primary reason for the new economic downturn base case. It is now being cited as the top external business risk by CFOs at 30%, followed by the related risks, inflation at 25% and consumer demand at 20%. 90% of CFOs say tariffs will cause resurgent inflation, and as CFOs worry about prices, expectations for the Fed for when the Fed can engineer it back down to 2% in keeping with its dual mandate, keep getting pushed further out. And pressure on U.S. Treasury bond yields is expected to remain, with 65% of CFOs saying the range will still be between 4 and 5% at the end of 2025. 50% of CFOs expect yields to stay within the lower end of this range, between 4 and 4.5%, where 10-year Treasury yields are today. So you're talking about a potential recession, but not a lot of CFOs think bond yields are actually going to come down, probably due to inflation pressures and the Fed not being able to react as they normally would if you were going into recession. Now, I think that's BS. I think the Fed is going to cut rates a lot if we start to go into a recession. That's, I don't see an environment where we get a recession and the labor market starts to really deteriorate and we have an inflation issue. That's just not how things work. We're not going to have an inflation issue if we have a recession. It's one or the other. If you have a recession, no inflation issue. If you have an inflation issue, then no recession. Because why? Because companies respond to demand. So imagine you run a factory. I don't care what it is you build, okay? Everything will sell at the right price. If Lamborghinis were selling for $80,000, you would see a lot more people driving Lamborghinis around. But they sell for hundreds of thousands of dollars, so they're a little bit less common. But same goes for everything else, whether it's a computer mouse or a book, or doesn't matter what it is. Price is important. So when you think about a factory that, let's say, can produce, 100,000 of these Axe body sprays a day, okay, at $5 a piece. I don't think they might be $5. I don't even know how much they are, honestly. But let's say $5 a piece. Well, now we're going into a recession. And the factory can produce 100,000, but people are only buying 80,000 at $5. Well, the company may decide to lower the price to $4. In that scenario, now they maybe can sell 95,000 a day. Then they drop the price a little bit further to $3.75, and boom, that's the magical number. Now they're selling 100,000 a day again. That's why you don't see inflation during recessions, because companies would rather lower prices than idle their factories, because that usually costs a lot less. Okay. And the factories, companies tend to lay people off, things like that as well. So this whole middle ground where we have a recession and inflation, it's just not true. Now, I did find that very fascinating, but today we also did get the CB Consumer Confidence Index for March. Last month, you were at 100.1. Check this out. You were expecting this to fall to 94. In fact, it fell to 92.9. This thing is plummeting. And this is, again, some of that soft data that does eventually tend to show up in the hard data. Now, we have hard data coming out tomorrow with durable goods orders. I think you're probably going to get a really negative number there. That could be scary to some folks on Wall Street. GDP growth rate, quarter over quarter, final numbers for Q4. That shouldn't move too much, but again, it's always possible that it does. That comes out on Thursday. But the big data is personal spending for February. If that comes in negative again, oh boy, do we have a problem. Personal income month over month, and core PCE will also be coming out on Friday. Now, also hitting the news headlines today, here in red as a big breaking news story, Moody's, the rating agency, says U.S. fiscal strength deteriorated further since the rating agency assigned a negative outlook on the U.S. sovereign rating. So that's kind of like saying, guys, you're getting even worse. If you keep getting worse in your fiscal strength, fiscal outlook, we may have to downgrade you from AAA. Moody's says even in a very positive economic scenario, U.S. debt affordability remains materially weaker than for other AAA rated sovereigns. So saying the U.S., you don't really stack up that well against other AAA rated sovereign nations. Now, UBS says the S&P 500 could hit 5,300 due to visibility tiring U.S. consumers. UBS strategist Benju Bawija warns the S&P 500 could fall another 8% to 5,300, citing a tiring U.S. consumer. Key risks include weakening employment expectations, spending outlooks, and consumer confidence. He expects profit estimates to drop in the next few months, adding pressure on markets. Concerns also stem from upcoming U.S. tariffs set for April 2nd and Trump's unpredictable trade policy. Bawija notes the slowing U.S. economy, reduced immigration, and lack of new fiscal stimulus are now showing in the data. Analysts have cut 2025 S&P 500 earnings growth forecast from 12.5% to 9.5%, with more reductions likely. Think about how crazy this is. Since 2000 until today, the average year for EPS growth is 5.25%. The average analyst still is expecting almost double that at 9.5% EPS growth this year. Let alone if we go into a recession, the average EPS decline is 15%. Like, imagine that. Imagine what happens to markets if we're expecting 9.5% EPS growth this year, but instead we get 15% negative growth this year in EPS. Yeah. Again, that's why I'm not overly optimistic about the markets as a whole here. And again, Moody's says United States fiscal strength on course for continued multi-year decline. Fed Williams says households and firms are seeing heightened uncertainty. And Fed Kugler says latest economic data for early this year have shown some signs of softness. Kugler says return of positive goods inflation is unhelpful as it had helped keep a lid on total inflation and inflation expectations. Fed Kugler says it is estimated that 12-month PCE was 2.5% in February based on CPI and PPI data, and we get that PCE report this upcoming Friday. Now, Goldman Sachs says that April 2nd could bring a negative tariff surprise. Goldman Sachs economists note recent media reports have suggested the Trump administration is leaning in a more benign direction on tariffs. Don't be fooled, they write. The attitude probably sets markets up for a negative surprise. Goldman notes that the Trump admin has seen tariffs as a negotiating tool and will likely want to start from a position of strength. A recent Goldman survey shows that market participants believed reciprocal tariffs coming in April will amount to a 9% reciprocal tariff rate. Goldman itself expects that initial tariff rates could be double that, which would set the market up for a negative surprise next week. And this headline, didn't really hit the markets the way you think it would. It says here, U.S. could adopt a tool to apply up to 50% tariffs on partners, according to the Financial Times. And Trump considers a two-step tariff regime on April 2nd, which is basically the first round of reciprocals come on April 2nd, and then a more severe round come after that. So again, just a continuation of trade war drama, essentially. Now, also in the news today, India is open to cutting tariffs on more than half of U.S. imports. In response to the Trump administration's upcoming reciprocal tariff policy, the Indian government is reportedly willing to reduce tariffs on 55% of U.S. imports worth about $23 billion, down to as little as 0 from a current range of 5 to 30%. The risk reward is favorable for the Indian government, as it estimates as much as 66 billion of its exports to the US would be hit by tariffs under President Trump's new policy. Now, here on the day today, the CNN Fear and Greed Index is sitting at 28. That is a sharp move higher from some of the, well, it's at 30 now, it just moved up. That's a big move higher from some of the lows we were at over the past couple of weeks, being in extreme fear, like 18, 17 at one point. You've almost doubled the headline number on the CNN Fear and Greed Index. Market momentum, extreme fear. Stock price strength, extreme fear. Stock price breadth, extreme fear. Put and call options, extreme fear. Market volatility is neutral. Safe haven demand in extreme fear. And junk bond demand currently in greed. If you take a look at the percent of stocks trading above their 50-day moving average, today you're not doing a whole lot of anything, down about 0.5%. 33.34% of stocks are currently trading above their 50-day moving average. And we will get a new AI investor sentiment survey coming out this week. That should be coming out on Thursday. We really want to see, do the bulls rise following the little bit of a rally we've seen in the markets? Because you've been around 60% of investors bearish for over a month now. This will be the 5th week in a row if over 50% of people are still bearish. And you've been closer to that 60% level again the past 4 weeks, which is kind of unprecedented. Let's go ahead and take a look at what the short sellers are doing in their Tesla short positions. The stock is not really doing anything at the time of recording this video, down about 0.1%. You have 420,000 shares that are being covered today. 420,000 shares being covered is a lot, considering yesterday you had about 2.5 million shares that were covered as well from hedge funds and institutions. So they're continuing to cover. That's a great sign for the bulls. Option activity today from hedge funds and institutions is also very positive. You have 202 different trades totaling $135 million with a positive order value of 89%. So no matter which way you really want to look at this, it looks good for Tesla. And again, I still think some of that option activity, some of that gamma from yesterday, FOMO, if you will, could come back into the stock at little to no notice and continue to push the stock higher. If we take a look, a lot of that volume from yesterday did make its way into open interest. 27,000 for open interest at the 280 call, 12,000 at the 280, 250, 15,000 for open interest at the 285, 22,000 for open interest at the 290, 33,000 for open interest at the 300, and then 14, 15, 16,000, 10,000 above that as well. So be on the lookout for extreme volatility coming over the next couple of days. So again, if we can get above that 200-day moving average on Tesla, you're set up for a pretty clear rise to that 310 level at the bare minimum, in my opinion. Then it's 325. Then it's your 50-day moving average at 330, and then your 100-day moving average at 350. Those are the next levels that we should be watching for. But we'll, again, talk about that more in the next video. With that said, have a great rest of your day, and I will see you in the next one.